sec.
Okay, I think we are live. Just wait for Xiang to get live. Great, fantastic, everyone. Well, look, so welcome to anyone who's watching the RWA LinkedIn panel. My name is Thomas Churchill, so I'm the CEO of Cumberland Labs. And today we have a few guests with us. We've got Rob Montgomery from Revest Labs. We've got Shiliang Tang from Arbalos. We've got Gabriel Coleman from Hashnote and Asad Khan from Centrifuge. And really the purpose of this over the next 30 to 45 minutes is to talk a little bit about the use cases of real-world assets on-chain and how they can be integrated into DeFi. So the first thing I'd like to do is just kind of invite the guests just to give us a kind of quick 30 seconds on who they are, what they do, and kind of really where their interest kind of lies when it comes to RWAs. So Asad, do you want to kick off?
Yeah, absolutely. I'm Asad Khan. My name's I work for Centrifuge. Centrifuge is the first RWA protocol. We were one of the first to bring real world assets on chain with our partners MakerDAO. We've got a long history of working with DeFi protocols like Aave and others. And I do all things business development product within the DeFi space.
Fantastic. Thanks. Gabe?
Yeah, hi there. My name is Gabriel Coleman. I represent our DeFi ecosystem here at Hashnote. I'm just responsible for integration of all DeFi protocols into our native RWA product offerings here.
Fantastic. Rob?
Yeah, I'm Rob Montgomery. I'm the CEO and founder of Revest. We administer several different products, the Revest protocol and Resonate being chief among them. Resonate's where we come into the RWA sector. What we're doing there is we're facilitating the lending and borrowing against the future return on UST bills. So we can service other RWA assets. We're most interested in the sector from a principal protected, risk minimized standpoint. So what we're doing is seeking to engineer ways to lend and borrow against these assets without rehypothecating the underlying capital.
Okay, fantastic. And Shiliang?
Hey everyone, I'm a co-founder of Arbalos Markets. We're a principal trading firm focused on a wide variety of financial assets, principally derivatives, but do a lot and work a lot with DeFi protocols. I was previously founder of Ledger Prime, a multi-strategy hedge fund, which also invested and partnered with a variety of various DeFi protocols and platforms. Yeah, glad to be here.
Fantastic. Thanks, guys. So, I guess, taking a step back, if we look at kind of narratives that are permeating the space at the moment, real world assets, RWAs on chain is certainly kind of one that kind of dovetails in with kind of the continued institutionalization of the space. And I was kind of pointing out last night, RWAs have been around for, 10 years now, in the sense that, if you look at, mid 2014, when Real Coin launched, which later rebranded to Tether, stablecoins really, were certainly the first, RWAs, and especially kind of one of the most kind of important ones that, have, underpinned a lot of kind of, trading activity, transfer of kind of dollars globally. So this has kind of been around for a while. But I guess kind of first question to Rob, the pace of RWAs migrating on chain has actually been relatively slow. When we think about this over a 10-year horizon, we've seen maybe gold and some agricultural kind of RWAs and tokens released. Why do you think it's been a relatively slow burn? And in the sense that RWAs still make up a very small percentage of the overall kind of total crypto market cap.
I would say there's really two principal reasons. The first being infrastructure, and the second being from an infrastructure perspective. For the past decade, we have seen the slow build out of and really the experimentation in crypto needed to be able to support tokenization of real world assets. If you go back 10 years, we had Bitcoin. We didn't have smart contracts. We didn't have DeFi. We didn't have really any infrastructural elements that were able to support the transfer and utilization of these assets. Why would I want to have on-chain real estate if I can't find an on-chain lender or an on-chain buyer for that real estate? Why would I want to have T-bills on-chain if I can't go out and borrow against their future yields or borrow against the underlying asset even? The infrastructure explosion we saw in 2017 was the beginning of that experimentation, and that sent people tumbling down a wide variety of different paths. We saw the ERC20 standard become dominant. We see, as time rolls on, we see the ERC 721, ERC 1155 NFT standards begin to dominate last cycle. And with the development of core DeFi protocols like Aave, Compound, and Uniswap, you see finally the level of buy, sell, lend, borrow infrastructure really develop that we actually need to even support these sorts of economies. Because if you're going to go up against the existing people, you got to be better. You got to have something that they don't have. And until recently, we weren't even close. Now, the second thing, lesser extent, I would say that's the legal end. The legal developments needed to facilitate tokenization have been also an iterative process. We've seen early experiments like the ones in 2017, peter out and fail. We've seen more recent efforts iterating upon themselves to the point that we now have registered fund structures that are proliferating across the ecosystem. You got guys like Hashnote coming in and setting things up, according to a proper legal structure. And that legal structure is a huge component of what is needed to facilitate actual commerce in real world assets. Retail isn't just going to put their house on chain and borrow against it. Retail that's too much for them. The level of the size of capital you see moving around these assets is the size of capital that needs legal stringency, that needs clarity, and only now are you really even beginning to see the first glimpses of that clarity.
Okay, yeah, thanks, Rob. Shiliang, you're kind of obviously much more involved on the asset management side of things. When you take a step back and look from, say, a macro perspective, do you think that there have been changes in the macro environment which have kind of helped spur, the adoption and development of on-chain RWAs, whether it's interest rate environment? Is there anything that kind of you can think of which is kind of helping to drive this kind of adoption?
Yeah, I would say twofold in terms of my interest. Right, one was kind of obviously like a lot of the interest from the asset management and trading side exploded during like DeFi summer 1.0 in 2020, right? I think like that kind of spurred like the thinking of like, well, there's a ton of money to be made, like yields extremely high, but it's like inflationary tokens that are driving the yield. Like how can we find in the longer term like sustainable yields, right? And so that kind of like was spurred my original interest, and I started to dig a little deeper, and I invested and worked with various projects like Goldfinch back then to find like more like real world yields that weren't necessarily like inflationary and could kind of like stand the test of time like over a longer period, right? As like we kind of weaned off like the COVID like monetary easing environments and rates started to get hiked higher in end of 2021 2022. I think that spurred a lot of interest in terms of like, well, crypto prices were kind of collapsing, which resulted in these like inflationary yields also collapsing, and so we kind of saw this like vicious cycle of just collapsing yields in DeFi. But real world yields were rising, right? And so I think that drove a lot of the interest in terms of like, well, how do we bring this yield now that's higher than the native kind of like on-chain yields to on-chain, right? And so that kind of like spurred our interest to look even more at some of these various like projects and protocols. And for us, right, I think it's just kind of chasing, like, it's a cost of capital question, and that drives like all of our decisions, right? And so there were long periods throughout 2022 and in 2023 where it just made sense to park our capital in real world like assets and get exposed to yields there, as opposed to like on-chain narratives and yields, right? And so I think that's kind of our like evolution.
Yeah. Okay. That's a very interesting point, Shalane, you made. And I think at Hashnote we started to see the integration of RWAs into multiple different trading strategies across the space and across DeFi. One of the most interesting developments of recent year is the idea of integrating an ERC20 token that is interest bearing into these DeFi protocols. And by integrating not just money market tokens such as USYC, Hashnote's RWA token, we're also starting to see a much more robust level of sophistication that can be implemented in the DeFi space, in the investment space, in liquid strategies that you cannot have traditionally seen in the traditional financial system. I think that is that level of increasing, value for what you're getting is something that we're trying to leverage in the space at large.
Yeah. So in terms of kind of having a interest-bearing kind of primitive asset, which is kind of a composable piece of kind of a very liquid DeFi trading strategy, is that kind of what you're saying, Gabe?
Well, it's not just but it's also composability and being able to leverage other protocols with RWAs to increase the value delivered by these RWAs for the specific investment strategy that's being implemented.
Yeah. So Asad, I've got a question as well. This is kind of somewhat tricky one, but I mean, like, taking a step back, I think generally people think of kind of DeFi as this completely open, permissionless, like all you need is an internet connection. You can buy, sell, borrow, lend. Like, that's it. Essentially no limits, right? And then RWAs really represent TradFi, right? Which is regulatory compliant, KYC, AML, so when you think about blending those two together, in many senses you could think, well, they are kind of diametrically opposed. How do you see kind of the gelling of these two in a space where you've got kind of different kind of philosophies and requirements and should we say kind of characteristics that that kind of imbue both of those, TradFi and DeFi worlds?
Yeah, I mean, you're talking about building kind of two different cultures, right? Like, and I think, Gabriel, you were saying earlier, and kind of continuing on that, like this blend of what DeFi is today, this really open, composable world with truly like tech-driven innovation, and then like Rob and Xiang were mentioning the world of real-world assets is kind of infrastructure. It's a little more conservative. It's much more about principal protection and things like that, right? Rather than risk taking and speculation. Not that even saying either of those are a negative thing. I think what's interesting about the world we're in today is, like Xiang very observed, is that the last cycle where interest rates rose, real-world assets became the narrative, whether you wanted them to be or not. It was the only place you could really get yield that was going to compensate you for the risk that you're taking in the market. Now we're in a market where maybe yields go down, whether it's this year or next year, whenever you think it is, today, tomorrow. We will be in kind of a different narrative cycle, but that level of education will still be there. So then you take let's say a crypto native kind of market, which is very sophisticated when it comes to trading and investing and transactional opportunities. You then take the education they have around, like, let's say, risk adjusted yields, legal structures that like Rob was mentioning, and maybe just the structures kind of inherent to the market of real world assets. you combine those two together, I think you do kind of have this like perfect Cambrian explosion. That word's super overused in our market, but it is really interesting to think about what you can enable with institutional DeFi, where you can use kind of real world assets as collateral, where you can actually trade against, assets linked to real economic markets, right, with real businesses behind them. And then you can combine those into all the DeFi kind of primitives that we've been building over the last couple of years. It's kind of a crazy world you can think about, especially if you think about maybe then the intersection between those two, right? Leverage on Bitcoins and then ultimately buy into CMBS, right? That's kind of maybe a crazy world, and I say that with a smile. Not sure if that's the world that will be the right one for us, but it's a crazy world, and I think that's the world we're getting into. So I think that's kind of the bridge we're seeing that's being navigated today.
That is exactly where we are trying to take it. What we see is you've got this money that needs to be kept safe. This is what we're doing presently. We allow you to come in, take your real world assets, and borrow against the future return on them, such that the loan will automatically pay itself off after a period of time. You can then take that borrow, and you're not risking your underlying value. And you can, now you have, first off, you started out in a KYC'd safe section of DeFi. It's, these RWA tokens, only certain wallets can hold them. Since they're whitelisted, only certain people can even access them. Accredited investors, qualified purchasers, depends on who's doing the tokenization, what their requirements are on this. But by borrowing against that future return, you can actually escape the walled garden of KYC AML and the low risk world that you are in. And without actually increasing the risk to your investors, you can then take that capital and go deploy it into the wild wests of DeFi, the 10x levered perps on Bitcoin, the going off and buying dog with hat. You can take that capital and go play in the much more interesting, but also more dangerous sector without the risk of screwing up and losing all your investors' money.
So one question actually for the panel here is, if we look at the development of kind of real world assets in the space, obviously starting with stable coins, sort of gold, some agriculturals, now obviously, with, the front end of the curve at, 500 basis points or whatever, interest bearing stable coins obviously make a lot of sense. Like, where do we go from here? The people who've been talking about, real estate on chain for as long as I've been in the crypto world. That hasn't really materialized. People talk about things like art and wine and whiskey, equity. We saw a little bit of that with FTX. So where do we go from here? Is it credit, fixed income? Loan origination. Be interested to see where you guys think the puck is going when it comes to the actual underlying assets that we think are going to migrate on chain.
Yeah, it's interesting you mentioned the next generation of assets that we see on chain. So at Hashnote, we are a regulated asset manager, regulated under SEMA in the Cayman Islands and as a commodity pool operator in the United States. We offer other types of RWAs on the platform besides USYC, and we exhibit a high level of due diligence process to any individual asset that we may offer on our individual platform. The reason we do this is because many of these are other RWAs. They are subject to what the industry has also termed the adverse selection bias, where assets that do not really find a home in TradFi end up finding it on chain. And so retail investors or non-institutional investors are exposed to blockchain investments, other types of RWAs that are not necessarily of quality and offer a higher level of risk for the return that they're getting. And so I think that the industry has to take an individual step at making sure that those assets, putting them on chain as a unique value proposition to those assets. And we do have a few offerings that will encompass those ideals, but also enabling better types of syndication for these types of better strategies as well, and integrating them into the broader ecosystem.
I think personally that we'd see a very strong drilling down into the most common fixed income instruments. That to me is the most straightforward. I hesitate to say simple, but perhaps obvious implementation of RWA tokenization systems. I think the next evolution of that technology, at least from where I see demand, is very much going to be, we have general money market strategies now, and people are starting to do more specific stuff. I know Hashnote is playing around a little on that, actually. I'm not going to say too much more. Or at least that's the impression I've gotten. But being able to take a look at specific portfolios that already exist and mirror that basket on chain, that to me seems to be where the winds are blowing, simply because you have so many clients who like having their own portfolio and constructing their own portfolio, but aren't at the current time able to replicate their portfolio makeup with the generality of existing offerings. So being able to replicate, okay, I've got a portfolio that's 10% 3-month T-bills and 80% 6-month T-bills. If I want to replicate that via an RWA tokenizer, I think that is a niche that is yet to be filled. And I think that when that niche is filled, we start to see some really interesting on-chain asset management platforms where you functionally have registered investment advisors offering services on chain. That is, trading the composition of the portfolio, incredibly rapid rates, maybe AI driven, but you actually see the replication of what traditional asset management looks like in an on-chain, much more fast, much more efficient environment.
Okay. I think, want to go back to one of Rob's points earlier, and I'll throw this one at you, Gabe. One of the reasons why, perhaps we hadn't seen much development in this space was, on a regulatory basis, right? I mean, you guys at Hashnote, you have a money market token, that yield-bearing instrument. I mean, how did you guys think about the regulatory approach to that in terms of structure, in terms of the ability to offer it to US, international, clients? I mean, what was the approach that you guys took?
Yeah, it's interesting you mentioned that. You mentioned USYC and regulatory aspects. So we designed USYC with 3 key pillars in mind, right? One, the composability of the asset itself, right? Having it be an ERC20 token that can interact with DeFi, that can interact with many types of protocols. We also offer many derivative solutions on the platform, and we leverage this token in that particular solution that we offer to other external investors. We also look at, liquidity, right? Liquidity, or the ability to guarantee T+1 and in many cases T+0 redemption at scale, at larger amounts of size that are much more significant than what we're seeing with major stablecoins and other types of RWA tokens that we see on the list. But also 3, regulatory, the ability to offer it to both Americans and non-Americans in a consistently compliant manner. We chose the structure that we did, not necessarily because we think it's the most versatile, right? It is still USYC is a token that you need to KYC with us to be able to hold and use. However,
Reg D, is it?
Oh yeah, we offer it under Reg D, correct.
Okay.
We offer it in America under Reg D. Internationally, it would be considered a Cayman Island mutual fund.
Yeah. Okay. One question for Shiliang, again, as the resident asset manager. When you're exploring this space, would you get, when you're doing due diligence on these RWAs as they migrate into on-chain, as it were, what are the key things that you're looking for from a risk perspective? Because I guess when we think about RWAs, we think about ultimately you've got an asset that requisite characteristics are a blockchain, a reference asset, some mechanism to assess the value of that reference asset, obviously some kind of way to store or provide custody for that reference asset, which is off chain, and then a mechanism to facilitate redemption of that of the token or the reference asset itself. So I'm just wondering, like, how kind of you approach this from kind of just a simple, straightforward kind of diligence perspective.
Yeah, I mean, I think what got us very comfortable, I guess, using like an example with just initially kind of onboarding with Hashnote and parking some capital there, is the fact that it was regulated, and I've had experience with running like a commodity pool previously at Ledger Prime. I kind of know like the NFA and what's involved there, and the disclosures and regulatory like practices and whatnot. And I think like also just the fact that it's on chain, but at the same time, the product itself is like custodied and off chain, right? So I'm not necessarily worried about like smart contract risk or hack risk, in that regard, because it is like KYC, and I'm dealing with a known institutional entity. So that calculus is very different than like if I'm parking capital in like a very new like DeFi project that may or may not have been audited, where everything's kind of like sitting on chain. It's like bridged assets. That like calculus is very, very like different, right? And like also just like the assets that are in the pool itself are like from unknown entities, right? And we've had kind of pushback from counterparties or allocators, especially in this environment, the past year or so, where allocators just aren't comfortable with as much like DeFi exposure, partly from like headline risk, partly just from like risk to their other core businesses. So those are some of kind of like the calculus, and even like if you speak to like auditors, right? Like when you do a year-end audit as like a trading firm or a fund, that has evolved over the past couple of years as well, right? In terms of like how much assets can sit at the year-end kind of like snapshot within like various DeFi protocols, and how that income is generated. Like, is it from actually like known pools of capital? Can it be like traced back to its origin? Like we engaged with like Markham and Richie May previously, and so their kind of processes have changed tremendously, in the past year and a half, just from all the guidelines that have come out. And so, that kind of drives a lot of our actions and, and interactions with the various like projects out there.
Okay, thanks. Asad, kind of question for you, kind of twofold. One would be kind of permissioned versus permissionless in terms of chains for RWAs. I think that would be the first question. Your thoughts on that, and kind of I think the second is how you think about collateral when it comes to RWAs in kind of the on-chain environment, especially as it pertains to DeFi.
Yeah, so like to the first question, it's kind of a theme of the discussion here today, the role of compliance and I think regulation and all of this. I think the view here is that if you're talking about real world assets in the real world, then you're talking about having to adhere to real world frameworks. Holding a treasury bill asset is useless if you can't actually get access to the underlying treasury bill or the underlying asset or the underlying yield in a guaranteed fashion. And the only way to do that is to interface with the legal system, to interface with the traditional finance system, and that requires ultimately compliance and permissions, right? When you start getting into the world of permissionless structures, I think there is, we've seen stablecoins do that successfully. Obviously, there's a pretty, timely topic on Bitcoin, ETH, and securities, or what may not be a security. And, we've seen that world exist as well. The world of real world assets, I still think, is early for how do you actually properly get that into like, a bearer asset that you can trade without having to comply with kind of traditional rules and regulations. And I think the way that policymaking has gone in the last couple of years, it's been clear that kind of door has not been thrown wide open. Maybe it will be in the future, and we'll have kind of a sound framework that allows us to do that. But it's still very much like, we're in the early stages of trying to develop truly like bearer token assets, right? And And ultimately, if you're really talking about using real assets in the way most of us are, which is for principal protection, for kind of risk-adjusted returns, for the kind of the conservative side of your book rather than the risk-taking side of your book, I think ultimately compliance permissions are like part of the calculus. Can you get your money back at the end of the day? That requires permissions, and if you can do that, that makes a big deal. Thought Shilling actually kind of voiced that pretty well. When it comes to collateral, like, for a long time, this discussion in DeFi and crypto has always been just focused on yield, and collateral is always an afterthought, especially in the super transactional world where things can move as fast as a block can be finalized. You didn't really have to worry about what you were holding onto as much as long as you could trade out of it, right? In the world of tomorrow, I think the question of collateral is much more relevant. We talked about treasury bills and treasury assets in general, treasury bonds coming on chain, but there's now a question of, okay, is the token that I'm holding actually representing, the collateral that the yield is coming from, that it's being the underlying is throwing off, or is it being reflecting something else entirely, right? And so that's like a first question of collateral. And then I think the second question of collateral, and this goes back to this permissionless idea, is what can I actually do with it, right? If it's one thing to hold a token and earn yield, and Rob and Revest, it's kind of the world they're working on trying to solve and unlock, is how do I actually take those tokens and then do something with it, fulfilling my investor mandates, not taking too much risk, not taking too much exposure, and kind of engaging with the world in a way that's actually provides utility for holding onto these tokens. And that's a world obviously which is much more, let's say, risk seeking than like the kind of the risk off environment we were in previously. I think the third kind of then step after that is, I have good collateral, or I have good assets. I have good collateral, meaning I have quality structures, and my token actually represents something that's meaningful to me, right? This is kind of also the world that Central View is trying to build, regulated, compliant institutional asset managers, bringing them fully on chain. The third one is, I think, then it goes back to this earlier statement we had about the world of DeFi and what can I actually do with that collateral, and then also who can I leverage that collateral with. I actually think, my speculative view is regulated markets will be built around this. You'll see compliant L2s, you'll see kind of permissioned L2s, or even L3s, and you'll see marketplaces which look a lot like Uniswap, but now are kind of transacting within completely, like, let's say, permissioned environment and actually a lively kind of ecosystem. I think that's the thing we all forget. You throw up a walled garden, no one's going to go into it, right? You build an ecosystem around that walled garden where you can actually leverage now an AMM here with different utilities over here, different on-ramp and off-ramp providers, actually integrating with different jurisdictions and kind of market verticals. Now it's a much different thing. It's not just a walled garden. It's actually kind of a flourishing garden. And I think that's the world that, ultimately good quality collateral and good quality utility for that collateral actually enables for you.
Okay. Rob, I have a question for you here. I guess one of the concerns here is, as we think about more kind of regulated structures coming on chain, how do you think about privacy in the context of, assets residing on a completely open L1 or L2? When I think personally, I wouldn't be wild about, the ability for, someone to start, tracking my, more and more of my assets as they kind of come on chain. So I just wondering how you kind of think, how do you think the space is going to navigate privacy when it comes to, open blockchains and RWAs and ultimately, more assets and more value on chain?
This is something I've actually been thinking about a fair amount recently for slightly unrelated reasons. Can't talk about that project yet, but people will hear about it soon. Privacy to me is really a twofold question. First off, you have to link a person to a wallet. That's your number one step. And obviously, if they KYC'd, well, how public is that KYC? That's, I guess question number one is, can I just go look at whoever their tokenizer is and tell, hey, yeah, that's Arbalest. That's them. They're publicly listed right there. Most cases I've seen, that's not the case. So you would have to first off identify a wallet to be able to know, yeah, that's you, Tama. The second thing, though, is I think we're going to see the integration of ZK technology at a much ZK and dark pools. Those two steps. I don't know if dark pools is even the right term, but the technology that I've seen that I have friends who've been offering to me for this unrelated application is if I have a transaction that I want to make, I believe it's account abstraction. I can use the new account abstraction features to basically send them the transaction from my EOA and have my EOA send money to a big pool of money, which then effectively acts as a mixer and anonymizes that transaction, then sends the money out from that pool to wherever I wanted it to go. You have a big enough pool of money, you have enough people, sending in different transactions, and you set this whole thing up so that you don't accidentally create another tornado cache, get censored by the world's governments. Well, you created a system that allows for these transactions to occur without the problems associated with other systems. And it allows you to anonymize where you're sending your money and what you want to be done with it. In the context of RWAs, there is no reason you could not set this up. If it is profitable, if there's enough demand for this as a tokenizer or a specific tokenizer, I as an LP, I can show up, I can buy $100 million of Hashnote tokens and put them into such a pool, and then just charge everybody who comes in and out wanting to do transactions through my money. So they lend me theirs, and then they borrow mine and lend me their capital as collateral, and then I go ahead and execute their transaction on their behalf, charge them a spread. So I don't see it being a problem, and I see that if it becomes a problem, then it gets pretty easy to solve.
Okay. Gabe, similar question for you when it comes to privacy.
Yeah, so an interesting point that Rob made about a lot of these interesting use cases for ZK technology and ZK proof to support KYC. I think one of the bigger challenges for most issuers, not just us, we at Hashnote, we're blockchain first asset managers, so we are regulated. We are a regulated entity, but we try to leverage blockchain as much as we can. I think one of the biggest challenges is going to be getting more institutional counterparties to accept solutions like Quadrata, ZK Pass, and so forth, right? I think there's quite an interesting, landscape of technology, but being able to get very institutional counterparties to accept that type of technology, I think is going to be a huge challenge. And so for many of these cases, KYC is going to ultimately reside with the issuer itself. However, I think it's important to mention that, going off of Assad's point, that by creating, an ecosystem, right, by creating more use cases, more interoperability, and more ways to add value to that existing portfolio of RWAs that you can get from any individual issuer, like we've seen with the other stablecoins that have been out there for quite some time, the more use cases you start to see, the more value and the more incentive it makes to actually go through that KYC process to actually to go issue assets. I think that's something that's been that will be a driving factor in the RWA space.
Okay.
I actually find the concept of identity quite fascinating.
Yeah.
Layer 2 is where you're embedded, within you KYC, there's KYC layer 2, and especially decentralized identity. I think there's a very interesting future there.
Well, I mean, I think that's one of the, decentralized, identity on chain. I think is certainly one of those things that has been. I mean, I remember, back in 2016, 2017. What was it? Vinny Lingham's. What was it called again?
It was Civic.
Civic. That was the one.
Civic, I remember that one. Yeah.
Yeah. I remember back in the. Yeah, that was. I mean, there have been a few, right? But no one's really cracked it just yet. But yeah, I mean, I think that was 7 years ago. I mean, and still, we haven't really, we haven't cracked that yet. The last couple of minutes, guys, what I'd like to do is kind of go around the room and get some predictions this year. Where do you think, when it comes to real assets on chain, where do you think the year will end up? Obviously, it's kind of gone the other way with Bitcoin and the ETF. So that's kind of digital assets on TradFi. So that's kind of the flip side we're thinking about, which is real world assets on chain. So kind of kicking off with you, Asad, what are your predictions for the year?
Yeah, I've got a few thoughts. I'll try to bucket them, right? The first, I think, is, I think the stablecoin space is still maybe the most exciting space to be in. Altogether, it's like the perfect intersection of DeFi and real-world assets. Think about all the things we're talking about. Stablecoins seem to be kind of the right product and primitive to express some of these ideas and bring these kind of markets to life. So I think everything related there is going to be really, really exciting. I think then you're going to, I don't think we see a pivot back to the world of before, and we're going and just hunting the riskiest assets on chain. I think investment grade assets and that whole world starts to become really more interesting. Comes on chain for sure. You see the primary markets built out, and I think then you start to see some of these ideas about utility and secondary market trading kind of come to life a little bit as well. And then finally, I think we're going to see. There's been a little bit of this already. There's been this competition among real asset service providers, and that's been kind of pushing down fees and kind of services. I think we're going to see this step into like offering kind of additional value add on top of that. And I think I'd like to think that's going to come from a truly like technological kind of innovation, but it could easily come from the business and commercial side as well, where you have people that are really well educated on both the crypto native aspects and the credit and real asset sides of things, offering kind of businesses and opportunities for both sides of the market to take advantage of what we see here. I think that's kind of my take.
Okay, Cheyenne.
Bitcoin to a million. Oh. Bitcoin to a million.
Nice.
Cheyenne.
Yeah, I think for my side, I think just kind of like increased like composability and fungibility of just assets on chain. I think that's even though there's a lot more assets that are coming on chain, I think there's a lot of need for just still the infrastructure side. Like we've started to trade actually like structure certain trades, like one of them was obviously with Vest, and it was like a principally protected product where we borrowed against yields, and we actually used that to buy call options into the ETF. But we've also looked at using like staked assets as collateral for like options trades, or using like LP tokens like in the Uniswap pool or GMX to borrow against lenders, right? And using that to increase like the yield. So I think like as infrastructure and risk management and whatnot gets built out on chain, we'll start to see more and more almost like an on-chain clearinghouse, which is kind of like what a lot of projects and companies are building towards, right? It's almost like as simple as it is like an on-chain like CME, right? What makes the CME so attractive is just the capital efficiency that it kind of unlocks for institutional investors, and being able to do that on chain, I think is pretty powerful. And lastly, just like even for us, right? Like we do a ton of like OTC options. We trade a ton of options on various like centralized exchanges and decentralized platforms. Like the collateral and margin that is locked for trading these options is just sitting there. It's not generating any yield. Whereas like the real world, it does, right? And so like as the proliferation of yield-bearing stable coins and like unlock that, I think that enables just a lot more like activity, and certainly makes dealers a lot happier, right? Just in terms of all this like capital that's locked and just not generating anything.
Actually, sorry, before Gabe and Rob, we've actually got a few questions here actually from the LinkedIn audience. One question from Mark Fidelman. Sorry for pronunciation. What DeFi platforms support RWA now? I say Mountain Protocol, I think is a DeFi stablecoin, which I think is coming to market.
Yeah,
I don't know if they're.
You have us.
Ondo, yeah, Revest.
Mauve and Violet, that's like a regulated platform that's trying to build AMMs for real assets. It's a partner of ours.
Okay.
Yep. Cool. I also know that Injective Protocol recently announced a platform for RWAs.
I have a list somewhere, but
yes,
not in front of me. There are a lot. Is the overarching answer, and a lot of the traditional lending platforms are also looking to get into the space.
Right.
That is a little bit of alpha. I can't say anymore.
Yes. I could also mention, Arbitrum, Arbitrum, Polygon, and Avalanche have made, pretty large headwinds in developing their own ecosystems of RWAs.
Okay. Question from Oliver Butlin. Thoughts on using EigenLayer for restaking as a collateral token for RWA with secondary lien on staked assets if failure to deliver RWA? Yikes. EigenLayer with, God, I mean, for restaking RWAs. As I understand EigenLayer, it's originally set up, or it's being set up so that you can restake stake tokens in order to provide kind of, some kind of additional cost-effective security model when it comes to validators for, applications looking to build their own validator set.
I think he's suggesting that you put up the restaked tokens, your node's staked assets, as collateral for a tokenization, and then if you fail to deliver the RWA settlement, that you get slashed.
Oof.
Yeah,
that's
my view is that we've got a lot of stuff to work on the real world asset side before we can get into restaking and kind of combination.
Love it.
That's being meant. I think that leveraging restaking of RWAs might be a bit of a challenge. But one thing we do at Hashnote is we do allow for stake ETH to be used as collateral on options markets that can also be partially collateralized with RWAs USYC to allow for a sophisticated yield strategy that leverages both RWAs and liquid staked ETH. Now, you can consent on that. Would be possible for Hashnote to offer such a product with a restaking token, for example. And that is something that that could be offered on the platform.
Yeah, yikes. Let me see if there's any more. Let me actually, while I'm kind of looking for the final questions, Gabe and then Rob, your predictions for the year, and then I'll wrap up with any additional questions from the audience.
Yeah, so I think my biggest prediction for RWAs into 2024 is surrounding layer 2s and networks that are not Ethereum, right? The overwhelming majority of RWA capitalization is on Ethereum mainnet right now. And we started to see some implementation on Arbitrum and other types of networks as well. However, I do think, and for all their criticism, I think Blast has done a very good job of integrating SDI with their network as well, is that the networks that leverage these assets, these interest-bearing stable assets, are going to be the ones that have the most success into 2024 by leveraging these interest-bearing assets into their broader DeFi ecosystem.
Okay, and Rob, you gonna wrap it up?
Yeah. So I think I got several predictions. I would say that as this year progresses, we're going to see the widespread adoption of RWAs within existing DeFi institutionals. And by that, I mean L1 treasuries, L2 treasuries, DAO treasuries, and VC treasuries to a lesser extent, but also still, you got a bunch of capital sitting around mostly in dollars and in a lot of cases off chain. Why not bring it on chain and be able to, get that yield and get the benefits that having those treasuries on chain brings? I think we're going to see the adoption of RWAs by crypto insurance companies. Ion Protocol being one of the ones gunning for that. I think we're going to see a lot of integrations with treasury management solutions, just because these are the low risk, higher return plays that RWAs are a really good unlock for. Now, on the TradFi side, I think we do start to see some early feelers. I don't think we see any huge. Well, I had someone at BlackRock a while back tell me they're trying to put $1 trillion on chain. So we probably do see a huge movement, but we don't see a lot of huge movements, and we don't see huge movements trickling down to it. We see tests and feelers and early activity, but we don't see widespread adoption just yet. We're going to see the early days of TradFi wanting to come in and experiment with what they can do with RWAs on chain. I think finally we also see a lot of standardization and a move away from money markets into more individual representations of the individual fixed income or stocks or whatever you're representing, but no more pools of assets. We're going to start moving toward, okay, this is a 1 month that expires here. This is a 6 month that expires here. That sort of thing.
Okay. I'm going to wrap up with, not so much a prediction, but what I'd love to see, within the next year. One would be a bit of a proliferation of non-dollar stablecoins. That would certainly be one. And secondly, I'd love to see like a real liquid kind of relatively even medium-term interest rate curve on chain, really starting with dollars, but then also BTC and ETH. I think, once you have, curves on chain, then I think you really start to unlock, a whole kind of term premium, and you can start to kind of value things in a much kind of more, cohesive way. Because at the moment, we don't really have much in the way of kind of valuation metrics, and especially when it comes to kind of, native digital assets as well. So that's kind of my two kind of requests. So anyone out there, if you're working on either of those two things, let us know. And with that, I would like to extend a very large thank you to Gabriel, Rob, Saad, and Shilian. Thanks, guys. Thank you all for watching. Drop a comment. Thank you so much. Anything that we can improve on, anything you want to see next time around. And yeah, big thanks, guys. It's been a blast.
Pleasure.
Thanks
so much for having us.
Thank you so much, all.
Great chatting with you guys. Have a fantastic morning.
Thanks, everyone.
Take it easy.
Bye-bye.